3, 2, 1. We alive. But I'm not ready. Had some natural peanut butter. It's stuck in my throat. All right. How you doing, friends? Ernie here. And it is Monday. This is Thanksgiving Day week. It is Monday the 22nd. Oh, I can hear much better now. Monday the 22nd. And it is one of only 2 zero DTE days this week, as zero DTE is off for Thanksgiving. That's good. Needs a rest. Needs a rest to see whether or not these all-time highs are real or not. Man, we hit another all-time high today. It's just one after the other. It seems like every day is an all-time high. And let me tell you, if you were expecting it, if you thought for a moment that this could just keep on going, if you didn't have doubts, then it would be a very simple matter of just going long every single time. However, every day is different. Every day you're presented with various catalysts in the market, various events, disruptors, all kinds of things that could send the market going anywhere. And trying to figure out just how the market is going to react to any one of these things is really almost like an art form, or maybe it's a Swami realm, right? You need to be in the realm of Karnak the Magnificent. I don't know if you get that reference, but if you're my age, you do. That was Johnny Carson doing his act, mind reading, Ed McMahon. Anyways, I don't have a crystal ball. Neither do you. And we don't know for sure that the market is going to be going up that day, even though it's been going up almost every day. I guess you could say that, the odds-on favorite are that it will go up. However, how much it will go up is equally as important as to what direction that it goes in, particularly when you're selling premium, because when you're selling premium, you're selecting an area where you think that the market is going to settle on, where you can collect that premium. And really the only thing that we have to go by in terms of definitive areas where we think the market might settle, from a technical point of view, from an analytical point of view, is where the market has been before. So for instance, we use volume profile. Volume profile is volume at price. It's sort of the sideways bars that come out and will show you the level of activity of trading at various price levels. So you get a very good view of what the actual activity and where demand is and where demand is not in the market. We know that when you have a very large volume node, price, when it encounters one of these nodes from past, it will tend to hang out there because for whatever reason, the market has found affinity towards that level. It likes that level. It is comfortable there. Why? Nobody knows. Well, maybe some people know, but it's not us. So you can put a strategy on that where you're going to collect premium and with reasonable expectation that price will go to one of these nodes and hang out there for a while. And time is really what you need when you're talking about collecting premium. Time, volatility, delta, etc. If the delta is made up its mind and says, hey, I'm going there. I'm going to the mountaintop. Then you say, well, you know what? I'm going to join you, market. And I'm going to put my my premium collection strategy right there alongside with you. And we're going to wait out for a little while and, maybe have some coffee, maybe a sandwich, whatever. Look at the scenery, chase some pretty girls. Who knows? We're going to hang out right there with you and collect premium. That's great. That is great if you have that kind of market history, whether it's recent or even a little further in the past, where you have that kind of market structure that you can rely on. Because the market doesn't always go up. It can go up, down, and when it's inside of its range, it's got to deal with all this market structure, and those are things that we can predict. But when you're in an all-time high, there is no market structure. There's nothing. There's air. That's it, air. So how do you know? How do you know how high the market's going to go? And what will stop the market? What is the extent? When will the market run out of gas? And what gives it gas? These are tough questions. Now, with zero DTE, these are questions we like to answer because that is really a lot of what gives us our higher probability of profit, and our probability of touch is having a basic swag. A swag, SWAG, is an acronym, and it means scientific wild ass guess. So we need to make a swag of where we think price is going to hang out so that we can put on our time-based option strategy, because it's time-based because it's zero DTE, zero last day of expiration. It's going to expire within the next few hours. And we'd like to hang out there for a few hours. If we could, please. But there is nothing up above. So what do you do? Well, there are two things you can do. Now, first of all, you don't know if you're going to go up and stay up there, or if you're going to go up and what so often happens, complete reversal, go the other direction, find some place else to hang out and find some pretty girls or beer or tea or coffee or whatever you're looking for. So we're left with this unusual option. We don't want to overtrade. We don't want to guess. So we do something that is akin to a straddle. Now, a straddle, putting on a straddle, a pure straddle, where you buy a put, buy a call, and they both have the same strike price. That's a very expensive trade. If price doesn't move, that exacts a huge amount of risk. And with also a very wide range of prices, a full standard deviation from whenever you start. So that's a tough thing to put on. However, with a strategy like the butterfly, we can create something that we call a poor man's straddle. What is a poor man's straddle? Well, a straddle in of itself is something that if price goes up, it profits, and if price goes down, it profits. But it doesn't start profiting until it crosses that zero line and there's a spread, right? And on top of that, it's very expensive. The cost, the risk that you're putting on is very, very, very tight. However, you could simulate a straddle because you know, now a straddle is unlimited profit on the upside and the downside. But you know that you're not going to have unlimited price movement. In fact, you think that price may move approximately so much, and we can give a guess by looking at the expected move, which is nothing more than a measurement, a statistical measurement, given the current volatility of a one standard deviation move, how far price might move. Now, it doesn't mean the price is going to move that much. That's just a guess. Another swag, a technical swag. But what you could do is you could put a butterfly. Now, why would you put a butterfly as opposed to a spread? You could put a butterfly, a bullish butterfly and a bearish butterfly. Use them as directional. Similar to the way you would use a bullish spread vertical or a bearish vertical. But with a butterfly, you get many more different characteristics that are conducive to collecting premium. Now, when you put one of these butterflies on either side, the wings that you place on the butterfly, you can control their width, and you can also control the distance that the short strikes of the butterfly are from the point that you're trying to determine, because you don't know which way, up, down, whatever. So you can create what we call a poor man's straddle that, in effect, in a time-boxed area, will give you the kind of performance that you're looking for, that bullish or bearish, whichever the way the market is going, and give you what you're looking for. And because if it's going bearish, then you know that there has to be a volume node down there somewhere. You can place that very nicely, and you can place the other one, the bullish one, because it's going to an all-time high. You don't know exactly where. Place it somewhere in the vicinity of the expected move. That makes sense. Now you have all other types of things that you can do. Now, I gave you the basic case. 2 symmetrical butterflies, put them on either side. We call that a poor man's straddle. And the reason why it's a poor man's straddle is that you get the same effect within that boxed region, but with much less risk. Sometimes very little or no risk. No risk? Well, that sounds like a trade for me, Ernie. There are some caveats to that. Now, one way that you can reduce your risk, and because you're using the butterflies and not just spreads, you can play some magic with these butterflies. You can create a broken wing fly or a broken fly. And what a broken wing fly is, that's when the spreads are of unequal length on either side of the butterfly. And the beauty of this is that the one that has the shorter length will have less risk on that side, and the one that has the longer length, the wider spread, will have more risk on that side. So you could put the risk to the outside of the butterfly and the least amount of risk on the inside where you're starting. So you can create
new visitor,
what is sometimes called the Batman strategy. That's because when you put these 2 butterflies on, they look like 2 ears of a bat. And so that's one of our strategies. That is how we would naturally play something where we're really not sure whether or not we're going to achieve another all-time high or we're going to pull back or just stay right there in the center. We'll use the Batman. That's what we'll do. Or the poor man's butterfly. I like Batman better. Batman is a much better name for this strategy than poor man's butterfly. That really sounds kind of lame now, doesn't it? The poor man's butterfly. Now Batman. Batman. That's cool. So we use the Batman strategy, and with the flexibility that you have with the butterflies using broken wing flies, we can adjust our risk on either side. Now, not only can we create a symmetrical risk adjustment where the insides have less risk and the outsides have more, but we can control how much more or how little more. We can create a credit spread on one side or the inside or the outside. We can go even further and start thinking about ways that we might want to adjust this in the middle of the trade. So if the trade moves very bullish or very bearish, we might take off the short strikes of the weak side because those strikes will have achieved maximum gain. We can take the short strikes off, and now we're just left with the long strikes. It doesn't impose any more risk because we got every bit of juice that we could out of the short strikes of that butterfly. But now if price reverses, we have a supercharged ear. It's like as if the bat took its ear and then flipped it up. Hopefully that works for you. That's just made that up. So the butterfly, man, I wish it were called something differently because I don't like the name butterfly. We need a much cooler name for the butterfly. Now, Batman is cool. Bats are cool. So maybe we'll call it the Batfly. Now, Batfly, that sounds kind of gross.
returning visitor.
We'll work on that. All right. We'll work on that. We'll come back with you with our renaming of the butterfly and the poor man's straddle, which is now the Batman. And we'll come up. Now, the whole point of this is I was talking about trading all-time highs. Because it's so unknowable, we can control or model our risk to the upside, to the immediate at the money, and to the downside to any degree we want. We can make it a debit. We can make it a credit. We can adjust its size. We can have one strategy that is far out of the money and one that's less far out of the money. And there are so many things that we can do. And all of that is predicated on our understanding of the market structure and the catalysts that are in the market and the events that are happening. We bring all this together. We come up with our idea or scenarios of where the market might go, and then we can literally mold. It's like molding. It's almost like taking clay and adjusting your own personalized premium collection monster. And you decide how much strength it has on either side and how it behaves on either side. And in that way, we can get the most out of these all-time high trades, even though volatility is super low, the market is erratic, it's thin air up there, so any little thing can move it all over the place. So we can control our risk and our potential profit. Now here's the best part. When you're using these butterflies, we have flattened out our deltas and our gamma is flattened. That means that in the beginning part of the trade, we have very little to no risk and very little anxiety because any movement in price doesn't give us big price fluctuations in the value of our strategy. Instead, it gives us this nice smooth curve until we get near the end of the day when price and time are winding down and premium is decaying faster and faster and faster, and gamma risk is increasing. But all the while, we still have our risk contained. And we don't really care if we miss because our risk is so small and our profit potential is so large. So there's a way that you can take an untenable situation, a very difficult situation, low volatility, low volume, unknowable upside, unknowable whether or not you're going to reverse, the quick introduction of volatility that can cause chaos, and construct a trade, a strategy, using some basic tenets, the butterfly, in some creative ways to model your idea of controlling risk and making profit. That is how you profit in an all-time high market using 0 DTE. We're focusing down now. We're coming down. It's not just, I suppose, you could just put a long call or something and just, have it a day. But the odds are so woefully against you in that kind of strategy. With the strategy I just described, there's a lot of moving parts, but it works. It really works. All right, let's see. There are no questions. We have people watching, but no questions. That's okay. Maybe this was a little over their head. I don't know. Talking about a lot of things. But, yeah, with a little creativity, you can create an asymmetric opportunity, very low risk, very high profit potential, with a high probability of success. I know usually all those three things do not go together, but you can do it, especially if you understand the market structure, the underlying structure of the market and how price is likely to behave, and keep a close tabs on market events. You got to remember that we're only talking about a few short hours, and that's a lot easier to control in terms of creating scenarios than, say, several long hours or a day or 2 days. Every time you add more hours or days onto that equation, the complexity of all the things that can come into play increase dramatically. And that is the beauty of the 0 DTE, because you can compress it down to just a few short hours and control all of the aspects of that trade. All right. Oh, we do have some questions. When is the best time to enter 0 DTE? I would say there's an area of opportunity, and I think that the best opportunity is sometime from the night before until the market open. There is also sometimes opportunity, or you have to wait because of unknowable things that may happen, like economic reports might come out just before the market opens that force you to wait to see how they introduce a catalyst into the market. And you might have to take the trade in the early morning hours of the market. But the best times I've found are somewhere between 6 o'clock, which is actually when the future session opens the night before. So usually around later in that night after the market is opened. It's the Asian market that is churning around. And then between there and sometime before the U.S. market opens. I would go further to say that the period between about 7 o'clock in the morning to 9:30 in the morning is probably the sweet spot. That's where you're going to get most of your activity. Now, there are some cases where we can put a trade on at 6 o'clock the night before. It goes through the Asian market, goes through the European market open. There's plenty of volatility, and we could have collected enough premium by the time the U.S. market is rolling around to actually take the trade off before the U.S. market even opens. That's happened several times. So there are opportunities when you're using futures. You don't have these same opportunities with the SPX. Now, I understand today is the first day that the SPX will be trading 23 hours a day, just like the futures. However, not all brokers are supporting that. I see that Interactive Broker is supporting it, but TD Ameritrade with Thinkorswim, they are not supporting it, right? Tastyworks, they're not supporting it. So we're going to have to get on them and get them to support the SPX. Although I still prefer the E-mini S&P futures contract for 0 DTE all around, even though it has a little bit more expensive commissions and fees, it is a vastly superior product for trading and for what we do, because you have volume, you have 23 hours, you don't have any pattern day trader rule. It's just a better product all around. But some people are stubborn. They want to trade the SPX, which also has much larger margin, so you can't have the same kind of fine-grained control over it that you can with the futures. Let's see. Thomas is asking, Ernie, great talk. Could you put up some risk graphs on the broken wing butterfly versus the unbalanced fly? I will do that, but not right now. I will do a separate video on that, because this video is actually also the podcast. And the podcast is audio only. And I did that, last week, but it left the people that were listening to use their imagination to a fantastical degree. So I will do another video separately where I'll get on my iPad like I did yesterday, Sunday. And you can go and you can see that video, the retrospective video, if you go to my YouTube channel, where I used the iPad and did all the graphs and everything and talked about those strategies in particular. All right. That's about it. And we've come to the end of another 0 DTE, 0-DTE podcast. Never forget that dash. That dash is so darn important, because without the dash, you have trash. You know what I mean? 0-DTE.com/try, TRY, if you want to try out the service. You get a 4-week trial. If you want to join us after that 4-week trial, I will rebate the cost of that trial. Regardless, even if you don't want to, that 4 weeks, you're going to get such an education that you're going to pick up some skills that you're going to be able to bring with you for the rest of your life. And it is going to be life-changing, I promise you. All right. Now we're done. Thank you very much. We'll see you Wednesday. That will be the last 0 DTE day this week of Thanksgiving. a wonderful week, and then we have Black Friday, and then Cyber Monday, and then the whole rush to Christmas. Oh, it's a wonderful time of year. Kinda, except for here in the Northeast where it starts getting colder and colder. Now I'm rambling. Thank you, and peace. All right. Off button. Where are you? Oh, there it is. It's way up there. End stream.